Okay, in previous class, we have learned how the bank can generate money supply. And from those process, we also learn there's some inherited risk from this banking system, right? Then particularly the bank run. Okay? And then throughout modern history, so first we have established a central bank, which is Federal Reserve. And secondly, this Federal Reserve, so they have developed a bunch of regulations to avoid the potential loss or to avoid the potential damage of the bank run. Right? So this bank regulation include the following four measures. First is called deposit insurance. Right? So what's deposit insurance? So these days, if you go to any legal bank, right, or means like the bank was registered at the central bank. Right? So usually there's a sign on their counter, right? So these signs look like here. Okay. What this means? So they just says so for each depositors. Okay, so the bank will insure their depositors at FDIC. FDIC stands for Federal Deposit Insurance Corporation. So this is a federal agency. Sorry, so this is not agency. This is just the federal sponsored company, right? And so this is going to ensure the money the depositors saved in the bank. Just in case the bank fails, the depositors have a place to compensate of their loss, which is like this is similar to like home insurance. If there's a damage, if there's a fire, and then the insurance company will pay for a certain amount of the damage or the cost. But obviously, so this insurance comes with a cost, right? Or the operation cost for the bank, because the bank need to buy insurance for each deposit or for each depositors they have, right? But then, so there's a cost and a benefit. The cost is the cost to buy the insurance. The benefit is going to protect the deposit or the depositors. Okay? So this is the first regulation. Second regulation, capital requirement. What is the capital requirement? So essentially, it requires the owners of banks, they need put their own money in the operation of their business, right? So why we need to do that? This is because remember in the early example, so we say there are 100 individuals, each deposit $1,000. With a 10% reserve ratio, the bank will make $90,000 of loan. This loan or this investment can be risky. Okay, and particularly this is somebody else's money. Okay, so now to avoid the potential loss, avoid the excessive risk-taking behavior, this regulation requires the bank's owner, so they have put some of their own money into the operation. So that's going to give them incentive to monitor this investment or to invest very cautiously or very wisely to avoid the unnecessary risk. Okay, so this is the purpose of this capital requirement, or this is how the capital requirement can help reduce the potential risk of bank run. Okay. The third is reserve requirement. Okay, so that just money the commercial bank is required to set aside, right? As we explained to earlier, so the higher the reserve ratio, certainly the safer, because you have more money wait for the depositors to withdraw, but you have lower ability to generate money supply. To lower the reserve ratio, and then the financial market becomes more leverage, but then there's higher risk. Okay? And lastly, this is called discount window. So this is the last resort in some sense. Okay, this is an arrangement in which the Federal Reserve, they will lend money to banks that are in trouble. Okay, so this is a discount window. So actually, so the bank run, it did happen. Right, so most recently, 2008, 2009 financial crisis, there are several episodes of bank run in the United States and in Europe. Okay. All right. So now, let me explain to you what is Federal Reserve and how Federal Reserve use their policy tools to regulate the economy and particularly to mitigate the fluctuation of our aggregate economy. So the Federal Reserve is a central bank. Okay, actually, this is a central bank for the United States. Okay, so different countries have different names. So, for example, Britain, so they have the oldest central bank. It's called the Bank of England. So Japan has its own central bank. It's called Bank of Japan. And in Europe, so besides the central bank for each individual countries, they have a big central bank. It's called ECB, European Central Bank. So that's going to oversee the member country of Euro. So Euro, this is the current currency adopted by many continental European countries. Right? So now let's focus on the United States. Okay? So the Federal Reserve, they oversees and regulate the banking system and control the monetary base. Remember, monetary base includes currency in circulation and reserve or required reserve. Right? So the current chair is General Powell. Right? And here's a roadmap. This is a map for each district. So there are 12 districts, right? The board of governors, that's kind of the headquarters, right? So we are here in Nebraska. So we was supervised by the Kansas City Federal Reserve Bank, right? And here, so this New York Fed is pretty important because this is where the Wall Street is located. Okay. Now, so the first things the Federal Reserve can do is kind of regulate or supervise the federal fund market. Okay. So what is this market? See, this market allows banks that don't have enough reserve requirement, so they can borrow funds from banks with excessive reserve. Okay? And what this means? Say, for example, there are two local banks. First National Bank versus Great Western Bank. Right, so both they have office and a lot of office in Omaha. So think about, so if First National Bank, they have, let's say, for example, they have 1 billion of deposit, and then they suppose they have 100 million of reserve, right? And the Great Western, say for example, they have 500 million, and then so they suppose they need to have 50 million, right? So they have 50 million of reserve. Now, say for example, for some reason, okay, so Great Western, so they end up with have 60 millions of reserve. It could be the case they haven't found a good investment opportunity yet, so they just leave more reserve than is required, temporary. But First National Bank, so they have lots of good project, And so this project is so urgent, so such that so they run low on the reserve. They only have 90 millions of reserve, right? And then so how they're going to satisfy the shortfall? So apparently here, so there's a shortfall of 10 million reserve. And then there's a federal fund market. So essentially, First National Bank can borrow from Great Western Bank. So the rate is going to be federal fund rate. So this is a rate, interest rate that the banks borrow from each other. Okay, so this is different from the interest rate individual business or individual households borrow from the bank. So this only works for the banks, right? And in the US, sorry, in the Europe and particularly in UK, so they have a different market, a different name. So LIBOR, London Interbank Offer Rate. So that is the Europe's equivalent to federal fund rate. Okay, but anyway, so the key message here is there exists a market that allows banks to borrow from each other to satisfy the reserve requirement, and then they can borrow at this particular rate, right? Right. But then, so this discount rate is different. So discount rate is a rate the Fed will charge when banks borrow from them. Or in other words, so let's say this is a central bank, that's called Fed. And then there are many commercial banks, right? So the commercial bank themselves, they can borrow from each other through the federal. So this is in the previous slide, right? Federal fund market, federal fund rate, okay? So they just federal fund rate, FFR. And the bank also can borrow from Fed. So this is called discount rate. And this or excuse me, as we saw earlier, this is called a discount window, right? Now we are ready to see so how the Fed can change money supply. Apparently, so the Fed can change money supply by changing the reserve requirement. Why? Because as we studied earlier, the higher reserve requirement is going to reduce the bank's ability to make loans. So that's going to reduce the money supply. Alternatively, the Fed can change the discount rate. What is the discount rate? Discount rate is the rate the banks borrow from Fed. The more expensive for bank to borrow from the Fed, the less resource the bank have, and then the loan they can make is going to lower, and then the money supply is going to decrease. Okay? So those are two traditional methods the Fed can use. But in reality, the Fed usually don't use these tools. Okay, so you will see the main reason why in more advanced class. Instead, so here I'm going to explain the main tools or better tools the Fed will use in reality. This is called open market operation. Now let's see how this open market operation works. So this open market operation largely works through purchasing or sell treasury bond. Okay, what is treasury bond? So in this background picture, this is an example of treasury bond. So essentially, this is an IOU issued by the U.S. Treasury. Okay, so the U.S. Treasury borrow from the public so that they can finance the government spending, as we discussed in previous chapter. Like here, okay, so this is in 1975. Okay, so the treasury bond here, so the face value is $10,000, and the rate is 4.25%. right? So the Fed conduct open market operation by acquiring or purchasing this type of treasury bill or sell this treasury bill. But usually they don't doing business with treasury directly. So they do the business with other financial institutions, usually the bank. Right. All right. So now let's see how the purchase or the selling of the government bond can affect money supply. Right. So we will have example, okay? Now let's see, okay, this is example, right? Actually, this is the Federal Reserve's assets and liability, or the T account for Federal Reserve. Now, Federal Reserve, their liability is going to be monetary based. So this include currency in circulation and a bank reserve. Right? How we understand that? So the currency in circulation essentially is the money printed by the central bank. And the central bank use the print money to acquire some goods and service from the general public. And then so that's the equivalent to say, okay, so the Federal Reserve owns certain amount of money to the general public, whoever holds this currency. And besides, so the commercial bank, they put some reserve in Federal Reserve, right? So like we discussed earlier, so that is the regulation, usually 10%. So that's the liability of the Fed to commercial bank, right? So this is their liability. But use this resource or the money, so the Fed can do their own investment. Usually they invest in government bond by purchasing treasury bill, right? To summarize, so the Fed get the money from general public and from commercial bank. Use this money, they invest in treasury bills, right? Now, in the open market or through open market operation, the Fed can change their holdings of government bond. So that is going to change the bank reserve. So the change of bank reserve is going to affect the size of monetary base, and eventually that's going to affect money supply. So that's how the Fed can affect the money market. Okay. Now we can look at two possible operations the Fed is going to conduct. Okay. Usually, in order to increase the money supply, the Fed will inject reserve or increase the reserve for the bank. But how they can do that? So they can purchasing the bond, right, from the bank. On the other hand, in order to decrease the money supply, the Fed will remove some reserve. The way they remove reserve is by selling the sell the bond. Okay, now let's see. Okay, so actually in the next slides, I'm going to explain to you how this works. Right. So if the Federal Reserve conduct an open market operation of purchase of 100 millions of bond, okay, so the bank, whoever sell the bond to the Fed is going to gain reserve, right? Because if someone purchase, there must be a seller, right? So this in this operation, the Fed is a buyer, so they buy 100 millions of bond, and the seller is a commercial bank, so they sell 100 millions of treasury bill, right? Now let's see how this operation affects Fed and the commercial bank. Okay, now let's look at how their T account is going to change. Right. Start with Fed. So Fed, they purchase $100 million of treasury bill, so their asset increase. But how they're going to pay for this purchase? Okay, so they are going to increase their liability. Essentially, one way you can think about it is just they borrow. But this borrowing from whom? Actually, borrow from the commercial bank. And then that just says, okay, so the Fed is going to give $100 million of reserve to the commercial bank. So this comes from here. Okay, but then the commercial bank, they give away 100 millions of treasury bill. So that goes to here, right? So summarize, the Fed buy treasury bill goes here, and using the money here, right? So essentially, just increase the reserve for the commercial bank, or increase the borrowing. One way to understand, increase the borrowing of Fed from commercial bank, right? Now with this additional reserve, okay, the commercial bank is going to increase loan. That's going to increase deposit. Eventually, that's going to increase money supply. Okay, so this is open market purchase. Okay. On the other hand, so the Fed can sell government bond, right? So if they sell government bond, so their asset is going to reduce. They are losing 100 millions of treasury bill, right? And then so if they lose these 100 billion treasury bill, so they have money, so they are going to pay part of the liability, right? So they pay back to the commercial bank. Okay, so now the commercial bank, essentially they have less deposit in the central bank because the central bank just pay off their original borrowing. Now instead, because the Fed sell the treasury bill, so the commercial bank is going to buy the treasury bill. Treasury bill goes to here, right? And the reserve just goes to here. Okay. But then, so how that affect the money market? So the reserves decrease, then the loan the commercial bank can make will decrease because they need to satisfy their reserve requirement. So now they have less reserve, right? So the loan reduce, and then the deposit they can generate will reduce, and eventually, so the money supply will reduce. So that's how the Fed can increase or decrease money supply via all open market operation, right? So then you may be wondering, where does the Fed get the fund to purchase U.S. Treasury bill, right? Or in other words, in this example, right? So either they sell, or if they sell, so where they're going to put their money? If they buy, where they're going to get the money, right? So the answer is, so they just change. So essentially, the Fed is going to change this account. If they, let me just erase everything, it's clear to see, right? So if this is sell, if they sell the treasury bill, okay, and then so whoever purchased the treasury bill, all right, and then so the commercial bank is going to get the treasury bill, and then so what the central bank is going to do is they're going to subtract the same amount from this particular commercial bank's account at the Fed. On the other hand, if they purchase treasury bill, so the Fed is going to increase holding of treasury bill. The way they pay, or the money coming from where? So they are going to give or add some reserve to the bank who sell treasury bill to the Fed, right? Or to summarize, so essentially, the Fed is simply with the stroke of the pen or the click of the mouse, right? So then just change their T account, right? So this asset and the liability side, right? So in this open market operation, the Fed doesn't need physically print money. It only needs adjust the reserve commercial banks have at the central bank. Okay. So now here, so this slide just reinforce what we just discussed. If the Fed want to increase money supply, it buy T-bills or treasury bills, right? To pay for the treasury bills, the Fed essentially just allocate some reserve. But remember, this reserve is a liability to the commercial bank, right? So that just means so the Fed has more liability, or in other words, the Fed borrow from commercial bank. But with this increased reserve, the commercial bank, they can make more loans. With more loans, the money supply will increase, right? Let's just follow the money multiplier process we discussed earlier. On the other hand, if the Fed want to decrease money supply, they will sell treasury. So if they sell, okay, and then the buyers, typically the commercial bank, they will use their reserve to buy the treasury bill. If their reserve decrease, and then the bank loan must decrease so that they can satisfy the reserve requirement. And accordingly, the money supply will decrease. Again, that just follow the money multiplier process as we discussed earlier. Okay, so this is how the Fed can affect money supply through open market operation. Okay, so here we have simple questions help us understand this problem. So now we have a bank. Okay, suppose this is only bank, and all money is held in this bank. Now there are no excessive reserve. If the Fed makes open market sales of $50 worth of T-bill, what will happen to money supply? Okay, so there are two steps. Step number one, the easiest step is we need to identify the reserve ratio. Right, so that's simple. That's 100 divided by 1000 equal to 0.1. This is step number one. Now step number two. So what is the impact of this open market sale on the Fed's, on the commercial bank's reserve? Okay. So if the Fed sells 50, because this is the only bank, meaning this bank is going to purchase $50 T-bills from central bank. Okay, and then the way the central bank can pay for this $50 of T-bill is by increase the reserve, or in other words, the central bank is going to allocate additional $50 of reserve to this bank. Now, because of the required reserve is only 0.1, meaning so the bank will make loan from based on this $50 of additional reserve. But remember, so this money generating process is going to ripple through the economy, and eventually, so you have $50 additional reserve, and then so you times the multiplier, which is 1 over RR reserve ratio. So that's going to give you 500. Okay, because this is 0.1, 1 over 0.1 equal to 10. Okay, hence the answer is going to be C. Oh, sorry. The money supply decrease. Wait a second. The open market sales. Oh, sorry, yeah. So because the Fed sells, and then so the commercial bank purchase means the commercial bank must purchase with the reserve. So the reserve is going to reduce. Apologize. So it was flipped, right? So the answer is D. Okay. Okay. Now For the rest of the time, so I'm going to briefly talk about how the Fed implement monetary policy and how they can move the interest rate to affect aggregate output, but eventually reach the goal of mitigating the fluctuation of our economy. Right? To understand that questions, we need to understand the determination of interest rate through money supply. Right? And then, so we need to look at the demand for money and supply for money. So here, the demand and supply is going to join to determine the interest rate. But eventually, this interest rate is going to affect aggregate demand through the channels we discussed in previous chapter, including affect investment, including consumption. All right, now let's see. So let's start with the demand for money, right? So the demand for money largely coming from the opportunity cost of holding money. Money, particularly the cash, okay, so brings us convenience. Because with cash, you can do the transaction anywhere, anytime, as you wish. So that's a convenience. But it comes with a cost. What is the cost? If you hold your money as cash, and then you cannot invest in the same cash into some interest bearing assets, meaning you cannot invest in assets that can yield interest, such as bond, right? So that's the cost. And then certainly the higher the interest rate, then higher the opportunity cost. Okay, and furthermore, so that's going to reduce the demand for money. And that's how we derive the demand. But to give you a sense, what is the opportunity cost? Let's look at some data. So in 2007, okay, the interest rate for 1 month CD, so CD stands for certificates of deposit, meaning so you just put your money in the bank for 1 month. Okay, this is a fixed term. You cannot withdraw earlier. The interest you can earn is 5.3%. Now, if you put your money into interest-bearing demand deposit, okay, we talked about demand deposit earlier, right? So this is more liquid because you can just call the bank and then just go to the bank, withdraw your cash, right? So this is more liquid and more convenient and certainly yields lower interest with 2.3%. Now, this is compared with currency. The currency will give you zero interest. And by the way, so these are nominal. Okay, so in the sense we have not factored in the inflation yet. If we consider inflation, and usually the currency gives you negative return. But nevertheless, if you look at it nominally, you can see so carrying cash is going to brings you an opportunity cost of here or here. Right. And here, so we also want to differentiate between short-term interest rate and long-term interest rate. So that's essentially, so just measuring the interest for different financial assets. Short-term is for the financial assets that mature within 6 months. The mature means, so you just put the money aside and in that particular financial assets, so you walk away or you cannot do anything with the financial assets. But then, so in 6 months or less, you are free, and then the financial assets give you the principal plus interest. Long-term interest rate is for financial assets that mature a number of years in future. So this is longer term. Okay. And here, so from the discussion we have, we can see the higher the interest rate, the higher the opportunity cost. The lower the interest rate, the lower the opportunity cost. But that's immediately affect the demand for money. Right? So from the discussion before, now we have the money demand curve. Right? Higher the interest rate, higher the opportunity cost, and then the lower the money demand. Otherwise, the higher the money demand. Because money is going to bring you convenience. Okay. So like before, so the demand curve will be affected by a few factors. So those factors are going to shift. Remember this shift, right? So this is not move along the curve. That's different. First, change in aggregate price. Okay? Higher price means we need more cash for transaction. And a lower price means lower cash for transaction. Hence, if the price increase and then the entire curve will shift to the right, you will demand more money, okay, to facilitate the transaction. Second factor, changes in real GDP. Okay? If there are more goods and services produced and sold, because remember, so when we look at GDP, so we can either look at the production or look at the expenditure, right? So, excuse me. So if there are more goods and services sold, meaning so there are more transactions, meaning we need more money to facilitate the transaction. Hence, the demand will increase. Demand for money will increase because we need more money to facilitate the transaction. Now, the other factor is changes in technology. So if the credit card becomes more widely available, then you need less cash to facilitate the transaction. Just think about recently or the past few years, we have all sorts of new technology to facilitate the transaction. This including Square. This is a payment company. Or think about Apple Pay, and then more recently think about this buy now and pay later company, think of firms, right? So this technology company will help us to facilitate larger transaction, but with the same amount of cash. Okay, so, or in other words, so that's reduce the demand for cash or demand for money. And then lastly, so maybe there's a change in institutions. So that's going to reduce or increase the demand for money supply, right? So now to bring to the table or to finish the picture, so we have first we have money demand, now we have money supply. Money supply because this is chosen by the Fed, so hence that's going to be independent of the interest rate. But actually, so the supply and the demand, supply chosen by Fed, and the demand that's coming from the market, they will jointly determine the interest rate. Okay, the interest rate is what we are interested in, and eventually this interest rate is going to affect aggregate demand through affecting consumption, investment, so on and so forth. Right? Okay, now let's see so how this interest rate is determined in equilibrium. Okay, so say for example, if the current interest rate is RL. Now look at here. So this is the money supply we have. This is the money demand we have. Meaning there is a surplus, there's a shortage of money, right? Because you demand more than you can supply. Okay? At the same time, it just means there are surplus of other assets, like a bond. There are less money go after other assets. Okay, and then those investors who sell in bond, because who have bond, they are trying to sell their bond. Then they are willing to sell at a lower price. But the interest rate actually is the inverse of the price of bond. Okay, so how we understand that? So the bond just says, okay, so I pay Q dollars today, and then tomorrow, so you'll give me $1. And then the lower the price, then higher the interest. Higher the price, lower the interest. At this interest rate, so there are lots of bond looking for money, or there are lots of people trying to sell the bond. And then they are willing to sell at a lower price. So that implies interest rate will increase. Hence, we move to this direction. On the other hand, if the interest rate is very high at here, and then the money demand is low and the money supply is high, now the reverse is going to happen. Okay, so we have surplus of money because this is money supply, this is money demand. There's a shortage of assets, so people is going to go after bond, and the investors who sell in bond, so they realize they can sell at a higher price because people have more money than the assets on the market. So they pay a higher price. The higher price implies the interest will go down. Okay? Or in other words, we are going to move to this direction until we reach the equilibrium. So this is very similar to the demand and supply we have discussed under several occasions. Okay? Eventually we are in equilibrium. Now, from the discussion here, you can see what the Fed can do is to undertake appropriate open market operations. Okay? Because open market operation is going to change money supply, right? Through what? Through change the reserve, right? So the reserve the commercial bank has at the Fed. Okay? Now, by this open market operation, it's going to change the money supply, and then from this, let's go back to this slide. So open market operation is going to change its money supply, right? So if the Fed purchase bond, they are going to increase money supply. If the Fed sell bond, they are going to decrease money supply. So you can see, so if the Fed purchase bond, increase money supply will decrease interest rate. If Fed sell bond, that's going to reduce money supply. That's going to increase interest rate. Right? So that's how the Fed affects interest rate, and finally reach their target federal fund rate. Remember, what is federal fund rate? The federal fund rate is the rate the banks can borrow from each other. Right? Now, so this federal fund market rate will eventually affect, so we already talked about this. Let's just skip and then I may come back later. So eventually, so that is going to affect our aggregate economy. Okay? Let's say, for example, let's start with expansionary monetary policy. That is the monetary policy increase aggregate demand. Okay? So if the central bank takes expansionary monetary policy, okay, increase money supply. How they can increase money supply? So they can purchase bond. Because, by the way, this is through open market operation, because that's going to increase the reserve of the commercial bank, and then the commercial bank can increase their loan, so on and so forth. All right, so increase money supply, and then from the demand and supply figures we have learned, so that's going to lower the interest rate. By the way, so this is interest rate the bank can borrow from each other. Okay. And then so finally, so that's going to lead to higher investment spending and raise income. And higher income is going to lead to higher consumption spending. Okay, this through the multiplier we have discussed in previous chapters. Okay, and then eventually that's going to increase aggregate demand and push the aggregate demand to the right hand side. Now you may be wondering why we need push the aggregate demand to the right hand side. Just remind yourself what happens if there's a negative demand shock. Right? So if there's a negative demand shock, and then the aggregate demand will go down or falls, right? So without government intervention, so yes, eventually we return, but this is going to be a painful and lengthy recession. And in previous chapter, we talk about the government can use fiscal policy to lift up. But the fiscal policy, one drawback of fiscal policy is there's a significant lag, right? Because it takes time to realize we are in a recession. It takes time to make up a plan, and it take time for the plan or for the money actually flow into the real economy. Okay? So monetary policy can do the same things through increased money supply. Okay? And actually, so this process is much quicker because the money is going to flow in around on a daily basis. Right? So this is expansionary monetary policy. But on the contrary, so the central bank can do contractionary monetary policy. So that's going to reduce aggregate demand. So that's going to serve as the opposite. Right? Let's just go back to the two slides that we just missed so that we can understand exactly how the Fed can affect the interest rate. Right? Look at it here. Okay. So if the Fed increases money supply, okay, again, so how they can increase money supply? Through open market operation by purchasing bond. So this is going to increase the reserve of the commercial bank. So that's going to increase the loan, increase the deposit, and then increase money. So that's how they increase money supply. So now increase money supply, and then so you can move to the right, you can see, so the interest rate will fall. Okay. On the other hand, if the, yeah, I think we have that. So on the other hand, if the Fed sells the treasury bill, then the money supply will decrease, and then the interest rate will increase, right? So one more thing that I want to add to this table is, so other way to understand why interest rate increase is if the Fed sell treasury bill. Okay, let's say for example we are starting at interest rate here. Okay, if it's Fed sells treasury bill, now there are more treasury bill, more T-bills in the market. Go after to the money. Okay, in order to sell those T-bills. Okay, and then so the price of the T-bills will decline, right? Because there are more T-bills. How are you going to sell? You have to lower the price. The price of the T-bill decline, that is immediate, means the interest rate on the T-bill increase. Now remember, so there's an inverse relationship between the price of the T-bill and their interest. Right? The other way to understand how the open market sale will lead to higher interest rate. Right? Anyway, to summarize, so the Fed can affect money supply through open market operation. And then, so the open market operation change money supply, affect interest rate. So this interest rate eventually is going to affect investment. That's directly. And then indirectly affect the income and the consumption. So this leads to a change in aggregate demand. Okay, and then depending on the economic situation or state of the economy, so the Fed may want to have a expansionary monetary policy by purchasing treasury bill, or contractionary monetary policy by sell treasury bill. Right. So that's all we are going to discuss for this chapter and for this semester, right? Thank you so much for your attention.